Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, and we will also take a look ahead at what we see coming up not only this week, but towards the end of the year. And so without further ado, Miles, why don't you jump on and show us those gold charts?
Yeah, Tori, coming off the Thanksgiving season, and certainly hope you all had a wonderful time with your families over the last week or so, but are glad to be back in the studio checking out the charts as all the metals continue to move sideways, possibly in anticipation of some of the no news on the trade deals that we're going to get into here in a minute. But looking specifically at the gold chart, do have a couple points on here that we brought up a few weeks ago, and a little bit of geometry in the pricing and some expectations. So coming into that first fib level, the 382, we have not had an actual retest yet. We have bounced up and down, and we did get down close to that 1450 number again, but it didn't quite get down there other than what happened back at the beginning of November. So sideways movement, and almost looks like it might be inching back up, which actually would line up with this 5-point pattern that Robert and I talked about 2 weeks ago, which could bring us back up to retesting the 1500 level. But I haven't quite given up yet on seeing lower prices. However, we are running out of runway here for this year. It is now good couple days into December, and as we round out the year and start looking at next year, it's not unreasonable to see gold either has already put in its bottom here at the beginning of November, or that should be right around the corner.
I sure hope you're right, honestly. I mean, that it has put in its low, because I'm like you. I still have that gut feeling that we're coming down lower, but we're up $20 from the low that we did put in today at 1475 as we record. So I'm actually encouraged that the price has been this strong. And again, we'll get to some of what Trump has said on trade, and that's been probably a big reason, along with the political uncertainty that we're seeing. But sorry, go ahead.
So we'll definitely see how this plays out over the next couple weeks. But for the time being, sideways right now on gold, although we have put in a higher low and a higher high in the short term. So a little stair step up, 1500 or closing in there, 1485 maybe. And then we'll see if we can push past those prices.
I'll tell you this, though. I mean, regardless, have a position taken. I think Robert has been the most vocal about the fact that December is the month to remember when it comes to an opportunity to step in and cost average. So whether you already own ounces or not, this is still an excellent entry month, whether it's here, whether it's $20 lower on the supposed correction that Miles is alluding to. Definitely probably going to see the window of opportunity go away based on first quarter strength historically.
Well, we are a weekly show, so we are going to talk about those weekly movements, but realistically, I started in gold 15 years ago, and I can't remember if I paid $300 or $350 or $325. I mean, in the long run, it doesn't matter. So for people that already have a solid gold foundation that's acting as that hedge against any other potential crisis on the other side of your portfolio, yeah, this show's for you. We're looking for places that we can possibly chip away at that. But if you're still on the fence as to the reasons why you want to own precious metals long term, especially with the news we've had politically, with the news we've had coming out of the Fed Reserve, at this point, I don't understand the wait.
So with the ratio widening here in this recent price action to 87-1 in terms of that gold to silver ratio, that's sort of a silver non-confirmation on this gold pop. What is that telling you?
Well, what that's telling me is with gold possibly putting in a low, now a very shallow low, only at the 382 fib level, but with gold putting in a very shallow low and possibly starting to inch higher, silver hasn't, I don't think, put its ultimate low in yet. So I wouldn't be surprised to see one last spike up in the ratio, maybe test that 90 level again, because we came down so close to that 618 fib on silver, which lines up with some nice 1-3 point on the 5-point geometry I'll have on the chart here. So one last push down to the 618 and then a turnaround from there. So if we end up seeing that, maybe silver down at 16 and a quarter, 1630, that would be my back up the truck price. So moving over to the other white metals, platinum, I think, may have put that low in. Early in the year, we were talking about gold leading the charge. Now it seems like platinum is, and we knew that would happen eventually. Eventually those ratios would cause these white metals to sort of flip-flop in the depth and the speed and the breadth of how fast and aggressively they're moving. So Platinum comes into its fifth point, it's turned around, it's bounced back up, and it's sort of sitting in between the 382 and the 50% line and bouncing up and down. But one good stair step up from there, and we're breaking into higher pricing, or at least going back and retesting the September pricing on platinum.
Well, it's to me laughable that you can buy an ounce of platinum for under $1,000 right now. Think about that. With where everything else is, gold and palladium, which I know you'll probably touch base on. $1,000 for an ounce of platinum, less than? Come on, that's just a gift.
Right, and here's where it's going to get real crazy, because here's my new target on palladium, 19 and a quarter.
Well,
I think we're going to get there.
Yeah, we're flirting with 1,900 today, right? And it continues to do what it wants to do.
So 19 and a quarter is my next, and that could just be the temporary stopping point for palladium. But 19 and a quarter is my kind of next top out point, and then I'd expect to see a little bit of a reversal off of that. But who knows if it's turning around or if platinum's just going to play catch up. So now as we shift over to talk about the equities, I think we're going to have to drag some fundamentals in here as the conversation gets a little deeper, because we're coming off of Black Friday and Cyber Monday, and why is the stock market down?
Well, you can call it fundamentals, you can call it news, whatever. I mean, we like to talk a lot about the technical analysis, but we like to talk about the indicators that seem to be causing gold to react, right? So gold and silver oftentimes are just in reactive mode, not really setting their own market at all, just kind of telling us, as a canary in the coal mine, that other things are going on. This week, honestly, I mean, we did see that one-day pop in gold from that low, and that came out just because of what Trump was saying about a no deal, potentially, certainly before the end of this year with China. Now he's saying that he potentially would even think that it's better to wait until after the election if we want to know the truth. And whether that's political gamemanship or just being honest, I'm not sure, but it could play out into his favor. But he says that China still wants to make a deal, but he wants to see if the deal is right. But all signs point to the fact that there isn't going to be a deal. Now, the equities markets didn't like that one bit on day one, and certainly much less on day two yesterday with a close to 400-point drop just in the Dow. So I think that we're going to continue to see some of that weakness, and gold should move up. Right? If it's a hedge, it's not always a perfect hedge on the equities markets, but oftentimes when there's fear in the market, you will see gold climb. So CNBC's closing bell mentioned that if Trump doesn't reach a trade deal with China and tariffs get put on December 15th, because that's the other talk here that could absolutely roil the equities markets and drive a lot of wind in the sails of gold. Siegel's saying on CNBC he doesn't want to be around equities if that happens. So you've got two things happening. News coming out that there won't be a deal by the year end, and these December 15th tariffs could be huge. In fact, Trump could end up looking like the Grinch that stole Christmas if that ends up happening, and that'd be really contraindicated to him with his political debacle that he's mired in.
Right. So are you encouraging people to get their Christmas shopping done early?
Yeah, maybe not in the form of buying stocks right now. Don't be doing that sort of shopping, but I would absolutely be on the sidelines on the equity side of things right now and let the end of the year play out. You've reached these critical highs. I'm sure you're going to jump in here a little bit from a chart standpoint, but I would say careful here, especially with those tariffs, essentially coming out December 15th.
Well, and here's what scares me the most about that, Tori, is if we translate that over to the Dow transports. Now, I think a season like Christmas is where this matters the most, because this isn't just talking about buying and selling of equity shares, buying and selling of companies. This actually is a season where shipping goods matters.
No, that's right. And you now have seen global trade fall for 4 months in a row. So it certainly feels like things could get worse. And it's not just Chinese tariffs. Everybody needs to look around and see what else is going on. I mean, the Trump administration is looking at raising tariffs on goods from France and Brazil and Argentina. So these heightened trade fears are coming with all this tariff talk. And now the sentiment on Wall Street has actually turned from extremely optimistic to suddenly pessimistic. And that also happens towards the end of a calendar year.
Sure. And I mean, Christmas shopping likely is down. I'll be interested to see what happens when we get the December reports come out next month. But I would be shocked at the way the transport chart looks and continues to fall. We're now 9.25% off those September 2018 highs. So while the industrials had broken through to those new highs, the transports have fallen sharply this month. and especially the last couple days with the beginning of the Christmas buying season. So there's not a healthy market out there. That's not investor sentiment that's rising the equities prices. It's investor sentiment that's pushing the transports down. We don't have the money to buy.
We don't, but that's what's happening. People need to realize the only reason that we have prosperity is because it's fueled by the credit markets, right? Well, credit markets means debt. So
right.
if you're fueling all of this through debt, well, then you're just kind of kicking the can down the road. It's not a viable economic picture. It's just easy flows of money. All right, so we've been building up this incredible bubble, and Greg Hunter, USA Watchdog, points out we are stealing from future generations more than $100 million every single hour of every single day. That's how fast our debt is growing. So we're at record highs at $10 trillion in terms of corporate debt. We're at all-time record highs in terms of household debt. We're at all-time highs in terms of national debt. So U.S. consumers are $14 trillion in debt. Right, we just passed $23 trillion in U.S. government debt. These are unfathomable numbers. You can't even measure these numbers and logically assume that we don't do anything except hit a reset button at some point, at which point the gold price goes parabolic because it will adjust to the new valuations out there in the market as a result of a default.
I think it is important to remember that these are market cycles. And when you don't allow the market to cycle, when you do what we've done over the last couple of years, that's when healthy market corrections and cycles turn into bubbles, turn into crisis.
Well, and that's actually being predicted a little bit here by Legg Mason. They're a diversified global asset management firm, and they say the probability of a recession over the next 12 months is now 50% or greater. So, but to your point, that's not fear-mongering. That's just increasing awareness. Cycles are healthy. Recessions are fine. When you overshoot, whether it's in the mother of all bubbles or the bubble of all bubbles, whatever you want to call this, or just a normal healthy cycle contraction, that's okay. All you do is diversify, plan accordingly, and then you reposition as soon as you see those prices come down in those other asset classes. Well, before we leave, I'm gonna throw out a little prediction here and step out on something because we're talking about debt increasing, we're talking about political uncertainty as the impeachment inquiries proceed, and we're talking about cycles and if there's a recession or not. What happens when you see those things play out? We tend to enter into new conflicts. And now you have North Korea that's sort of flaunting, getting frustrated because they're being ignored. And he's promising a Christmas gift for the United States, whatever that means. But this is where I'm stepping out. I'm going to say we have a new conflict in the next 6 months, either out of political survivability, which usually works for sitting presidents, or out of a need to turn around the economy, or 3, as a need to distract. And so my prediction in the next 6 months, whether it's North Korea or somewhere else, we'll be entering into a larger scale conflict.
Well, Tori, we'll continue to keep looking at the fundamentals, which are always shifting, especially on that geopolitical scale. So that's going to do it this week for Golden Rule Radio. As always, hit the subscribe button, ring the bell, head on over to our website, McIlvaney.com, Twitter, ICA Gold, or Facebook, McIlvaney Financial. And if you'd like to speak with Tori, myself, or any of the advisors here at McIlvaney Financial Group, you can give us a call at 1-800-525-9556.
Thanks and have a great week.